You guys just love talking about interest rates. It seems to be the question I get most days of the week. Where are the interest rates going? How is that going to affect my own home and my mortgages? What's going to happen with the property market when interest rates get cut? Are we going to have another boom? Where was this property crash? We were meant to have a property crash when rates went up and up and up, but it never happened. We're going to be breaking down what's going on with the RBA Governor, Michelle Bullock. What are they going to do this year? Are we going to see a cut in April or May in terms of interest rates? And how is that going to impact the property market? Now, my name's Luke and I talk all things real estate, renovating and financial freedom here on the channel. If you're interested in that type of stuff, make sure you hit the subscribe button below. Let's have a chat about Australia's property market, the economy and interest rates. There's just so much to unpack at the moment, but I think we need to take a look at some of the data and what's going on with the inflation markers, because that's going to drive the RBA's decisions. And we can take a look over the ditch at what's going on in New Zealand as well, because they might be a lead indicator as to what's happening in Australia's economy. So this article takes a look at New Zealand's CPI inflation, which, like in Australia, has fallen more quickly than the Reserve Bank's original forecasts. So inflation's coming back down, prices for things aren't increasing as quickly, and you can see this here in the not seasonally adjusted CPI inflation data for New Zealand on a quarterly basis. You can see it's coming down faster than anticipated. This is the blue line here, which is the Reserve Bank of New Zealand's expectations, and the orange line here is where the inflation data is actually tracking. You can also see in this next chart that inflation in New Zealand, inflation is falling across a wide range of categories. So it's not just one category that's coming down, drawing inflation down as far as the markets go. It's a broader range of categories. Now, Australia is seeing some similar data sets come through. So the Reserve Bank Chief Economist Paul Conway said in a speech on Tuesday the other week that the run of soft inflation and economic data does not imply that interest rates will be cut or there is less inflation in the economy. In a quote, he says, yes, lower GDP indicates weaker demand, but also that the productive capacity of the economy was lower than previously assumed. So in layman's terms, they're forecasting the economy was going to be more productive, and we've had less inflation and less production in this last period of time. So some of the senior economists at Westpac and ANZ and the big banks have been making statements based on this data and based on what the RBA is saying. One of the interesting comments here says that overall we view today's comments as being consistent with our forecast that any easing in policy is still some way off. Market pricing for easing in the first half of this year still seems premature. So let's get rid of the mumbo jumbo jargon and what does this mean for us in reality? I think what this is saying is the RBA is not going to cut rates too soon. I don't think we'll see a rate cut until May 2024 at the earliest. I think the problem is if they cut rates too soon, the market may get too bullish, property prices may have another run up, the economy may go into hyperdrive again, and then we're going back through another cycle. So I think what the RBA is going to want to do is to slowly ease the rates off. I don't think we're going to see big declines in the rates either. I think they're going to come down in 0.25 increments, and we may only see a handful of those cuts or rate cuts in 2024. What this means if you're a mortgage holder, an owner-occupier or an investor is that your mortgages are unlikely to come off a significant amount this year. So if you're sitting like I am around the 6.3 to 7% interest rates, depending on your mortgage, depending on whether you're principal and interest or interest only or whatever products you're on, a lot of my loans or all of our loans are with CBA at this point in time, and our rates are sitting around that 6.1 to 6.7% mark, depending on the interest only, principal and interest, investment or owner occupied status. So I don't think those loans are going to come off more than 0.5% to 1% in the next 12 months. So expect to pay around that 6 to 7% mark, probably around that 6% mark is where I'll be forecasting for reality. But always have your buffers on top. Even though you're probably expecting to pay around 6% with these rate cuts coming into play over the next 12 months, you still want to forecast at least 2 to 3% buffers when you're running your own numbers. Doing this sensitivity analysis is exactly what we do with clients when we're helping them secure a property purchase here in the Greater Brisbane market. Whether you're an owner-occupier buying a $1.6, $1.8 million home, whether you're an investor breaking into the market looking for some blue chip property between $700K to $1.2 million, whatever the price point is, as low as $300K, as high as a couple $1 million, whatever the price point is, make sure you're running your sensitivity analysis. Understanding where we're going, looking at what the economy economists are saying and what the RBA commentary says is important. But what's more important is running your own numbers. What is your income? What's your property's income from an investment point of view? What do your cash flows look like with these expenses? And adding some buffers in on top. Emily and I even run our cash flow scenarios as high as a 10% interest rate to stress test our property portfolio and to make sure we can handle a worst case scenario. There are some other interesting data points that happened over the last few months which may be affecting the RBA's decision. In this recent article from the ABC, they were going through some of the retail numbers. Now we've got retail sales figures from 2023 showing a 2.7% seasonally adjusted dive in spending during December. And usually December is going to be our big spending month. Everyone's jumping into Christmas, spending gifts on each other, winding down for the year. So seeing a fall is actually giving a good indicator of where the economy is at. The drop in December was the worst seasonally adjusted month result in the 4-decade history of retail sales data outside of the 2 months in 2020 from COVID and July 2000, the introduction of GST when many prices went up 10% literally overnight. So looking at those outlier years and looking at the data from December 2023, we can see spending is coming down. And this is also showing in that core CPI data that we looked at before. So to dive into a little more detail around that core CPI data, you can see the black line here is Australia. And it's quite topsy-turvy, especially with COVID. We had that big dip in inflation or core CPI. And you can see here, a lot of the other developed nations, United States, New Zealand, United Kingdom, are seeing a significant fall in their CPI inflation data. Most bands sitting around that 2 to 4% mark at this point in time, all coming off of highs between 5 to 7.5%. So Australia is tracking very similar to New Zealand. You can see the red line here in New Zealand, very similar to the United States, which is a little bit ahead of us in terms of dropping CPI data. And Canada is the front runner, having that dip earlier in 2022 around their CPI inflation data. So now we've talked about the economy, we've talked about spending dipping over the Christmas period and where rates might go in 2024. What on earth is going to happen with property prices? There was talks of a 2023 crash. We never saw that eventuate. Prices across Brisbane, across Perth, Adelaide, even Sydney and Melbourne grew in 2023, even though the cash rate went up 10, 12, 13 times across an 18-month window. So what is going to happen to property prices in 2024? Now, pulling out a crystal ball and looking at these markets, Brisbane's anticipated to see growth of around that 5 to 7% mark this year. But that is only going to be averages of averages. You're not buying the Brisbane market. You're not buying the Perth market. You're not buying the Sydney market or Melbourne. You are buying a property in a specific street with its own localized economy, with its own curbside appeal, its own access and amenity, lifestyle factors, income and demographic data. So when it comes to that specific property purchase, yes, you need to look at the macro level, what's going on in Brisbane and Southeast Queensland as a whole, but then what's going on at a suburb level, and then even more importantly, at a street and a property level. Also, what comes into account in terms of growth factors is bedrooms and bathrooms, the internal floor plan size. All of these have an impact on a property's growth potential and the relative yield you're going to get off of that home. I know some clients at the moment are working with us and I'm very excited for them because we're making some great offers on properties that are between $700,000 to $1 million. We're looking for properties that are walking distance to the local school, access to the local shops, dead-end streets, value-add potential, ticking as many boxes as possible for their specific situation to help them secure the right property for the right price in the right location. And once you've got the right property secured, it's then about seeing that compound growth and looking to tweak your property portfolio, whether it's to sharpen your interest rates. I called up my broker the other day and saved around 0.8%. So almost a full percent off of my interest rate because we rolled over on an interest only period onto a principal and interest period. and therefore they put us on a higher rate CBA straight away. It was at 7.1%, and we're down to around 6.25% for the same loan just by making a call to my broker and asking for a repricing. So look at tweaking your property portfolio. Make sure you're buying the right property for the right price in the right location. For 2024, I don't think we're going to see those rate cuts until the middle of this year at the earliest. I think the RBA is going to be conservative. And I think once we see rate cuts come in, property's not going to get any cheaper. The big problem we have here in Australia is supply and demand. There's purely too much demand and not enough underlying supply, and not enough oncoming supply either. Building is expensive, building is slowing, builders are going broke and going under. So what we're seeing in the market is that lack of supply and overwhelming demand. So given all of those factors, I think 2024 is shaping up to be a very interesting year from an economic point of view and from a property point of view. So if you want to sit down and have a chat with myself and you're looking to buy a property in the next 3 to 6 months here in Southeast Queensland, head over to purposeproperty.com.au. We'll sit down together for half an hour and break down your current position and your current property portfolio. We'll then discuss the steps you need to take to get to where you want to be from a capital growth and from a cash flow point of view. And then we can leave some time for some questions at the end after discussing our buying process. So head over to purposeproperty.com.au if you're interested in having a chat with myself. Otherwise, I'd love to hear from you in the comments down below. What do you think is going to happen to property prices this year, as well as the cash rate? Very interesting year for property, in my opinion. So leave a comment down below, and thanks for sticking around. I'll see you in the next one. Peace.